Good morning. It's Jeffrey Christian of CPM Group. It's 11:45 here in New York on Friday morning, the 11th of August. Silver is trading around 22.85. Gold's around $1,950 as we speak. I want to talk about all that silver, the fact that there is an enormous amount of silver around, and that some of the information that's circulating there may be making people bullish for the wrong reasons. We're bullish on silver, but for the right reasons. And those right reasons give you a much more sober perspective on where silver prices may go over the next 3 or 4 years. I also first want to talk a little bit about inflation, because we've had PPI released today, CPI yesterday. We've had Chinese inflation figures released earlier in the week. And I want to talk about investor interest in Treasury notes, because these things are all important to silver and gold. First, consumer prices in the U.S. About 0.2% month-to-month change once again. If you look at it on a year-over-year basis, you saw a small uptick in the headline, which is including food and energy prices. The core inflation, which excludes food and energy, continued to decline as it has been at a moderate level. The decline across the board reflects very sharp declines in petroleum prices, which don't show up in the CPI, but gasoline prices and heating oil, as well as natural gas. And those prices have all come off sharply at the consumer level during July. Gasoline prices are rising now in the last week or two, but they're rising having fallen very sharply for about 2 or 3 straight months. If you look at total CPI and you break it down into the components, we still have big issues with food inflation. And then you also see relatively strong inflation increases in prices for services, especially transportation services right now. So you're continuing to see a disinflationary trend, but it's been made to look a little bit stronger because of lower oil prices and energy prices, but it also continues to show real concerns in terms of food prices as well as service prices. You also saw similar data in the PPI, which came out today. Again, you had relatively stronger figures in the provision of services relative to the provision of goods at the wholesale level. In China, you've had now declining prices, weak demand within China, lower exports for a variety of reasons, have caused production to build up and goods and services to build up, and it's actually leading to lower prices, which is A, problematic for the Chinese economy, and B, suggestive that what we've been seeing over the last year or so, we're going to continue to see on a global economic basis. We have issues, and they're confounding some fiscal policymakers in handling it. The next thing I want to talk about are the market yields on treasuries. You hear all kinds of stories from gold bugs and gold promoters about how people are dumping treasuries and central banks are dumping treasuries. I've spoken about this in the past, and I gave a very good interview a couple of weeks ago, the last week of July, to Investor News Network. It's up on YouTube now, and you can find it. And one of the points I made was that, A, central banks are not dumping treasuries. If you look at the sell-off that we've seen over the last 18 months or so in treasury holdings, the vast majority of treasuries that were sold by U.S.-based investors. And they were selling them because the interest rate on those older notes that they had were 25 basis points, very low yielding treasuries. Interest rates have risen. You can see them going from 25 basis points to about 5.2 on short term. These are 10-year notes. They're about 4.2 right now. And so you had investors getting rid of low yield notes and buying in. What you've seen in recent weeks is very strong demand for longer term treasuries. 10-year notes are up very strong. The number of 20-year notes being purchased also has risen, along with 2-year notes. This is a long-term view to show you that even with the sharp increase that we've seen since early 2022, you still have at 4.2 for 10%, 10-year yields, historically low rates. That doesn't ease the pain for people who have mortgages that are tied to short-term rates or variable rate mortgages, or are looking to take out a loan on an automobile or other things. But the reality is that while interest rates have risen, they're not where they were. They're not where they were when we had real problems with really high interest rates prior to, say, 1993, 1994. On a shorter term basis, and this just goes back a few years, like 2019, you can see the big increase in interest rates, and you can sort of see that they've kind of topped out in recent things. The Treasury had I'll just see what it was. It was 2-year notes, and they had a massive $32 billion, I think it was, $42 billion 3-year note auction this week. And it was massively oversubscribed. As I said, you've also seen very strong demand for 10-year notes and 20-year notes from investors around the world. What you're seeing is a lot of investors who had said, I got to get rid of these low-yield notes when interest rates start rising, now starting to indicate that they think that the yields on treasuries probably are close to, if not at, their peak. So they're starting to reposition to lock in what they see as cyclically high rates. Just, it's another piece of data that suggests to you that financial market participants think that the period of interest rates, we might have another 25 basis point hike or two, depending on what happens on inflation and the strength of the economy. But that market participants are saying, okay, we might be 25 or 50 basis points from the peak, but these are attractive enough rates to start locking them in. Now, I want to talk about silver, because it's really what I want to talk about. On Tuesday in my video, I said, look, there's plenty of silver around. And if anybody doesn't believe me, if they want to listen to the guys on the internet who say, oh, we're running out of silver and the price is about to skyrocket, it's not going to 50, it's going to 100 or 200 or 500. If anybody wants to believe that and they want to buy silver, I stand ready, CPM Group stands ready to accumulate up to 100 million ounces of silver for you. And we'll do it without driving the price over $28. And I'll make that offer because I'm convinced from what we see in the market every day, there's plenty of silver around. And unless you're a complete clod in buying the silver, you can amass an enormous amount of silver without driving the price higher. It's part and parcel with this thing that we did last November, the CPM challenge. If you're a pundit on the internet and you keep waving your arms and talking about how gold and silver are going to $10,000, $20,000, $40,000, that's for silver. Get the gold. If put a date on it, say, and people are starting to do that. Oh, by August 22nd, gold price is going to be $10,000 an ounce. Fine, do that. And if it isn't $10,000 an ounce on 22nd of August, hang up your dancing shoes and go find a legitimate job. Right? So here's the silver price, and you can see we've been moving pretty much sideways for most of this year in that range of $22 to $26 an ounce. That's probably going to continue for the next several months. We might start seeing 26 being tested in the fourth quarter, but for now, I think we're sort of in that range. Now, people have questions. There are unprecedented deficits and silver prices haven't risen to $50, let alone $100 or $500. And a lot of folks point to the Silver Institute's data, which shows this unprecedented deficit. 200, 250 million ounce shortfall of physical newly refined silver over demand in the market. And they say, how is it that silver prices that's last year, not this year, that's last year, right? How is it that silver prices haven't skyrocketed in that level? They also asked CPM Group, why don't you show massive deficits? Why don't you use the Silver Institute data? After all, CPM Group created the World Silver Survey for the Silver Institute in 1990. What happened? Well, CPM Group's silver market data jives with what we've seen in the market year over year, decade over decade. Our research goes back to our research operation goes back to the late 60s. Our data goes back in some cases to the 60s, some cases to the 50s, and some cases even further back. But if you look at our supply-demand data and our analysis, we have consistently gotten the market right in the longer run and in the intermediate term by paying attention to the fundamentals of supply and demand. And you can see here, we have shown surpluses since 2005. And those surpluses have corresponded with rising prices. And when the surpluses fell in 2013, 2014, the price fell with them. And when the surpluses started to rise again a few years ago, the price started to rise again too. And no one should be surprised because that's what happened in the 1980s, late 1970s, early 1980s. And it all jives, it all ties together. So there's a lot of silver out there. Investors are buying more, which is why you have surpluses, because our surpluses don't have a dummy variable for investment demand. Our surpluses are total newly refined silver entering the market in a given year, less fabrication demand. Fabrication demand is someplace where you're taking silver and you're making a product out of it. It's no longer sitting there as a piece of readily saleable silver. Yes, you can take your jewelry or your silverware or your old electronics or your old solar panels down and have them refined into refined metal. And depending on market conditions, that might take a week, 2 weeks, or 2 months, or 3 months. But it's not silver as silver. If you look at silver as silver, you have a completely different story. In fact, you have nearly record levels of silver in refined bullion and coin form. The green part is the coins. These charts are both from our Silver Yearbook, so anybody who has been smart enough to spend $160 and buy a 250-page piece of research as opposed to marketing hype would see these charts, see the data behind it, and see the analysis that goes with it. If you look at above ground inventories of refined silver in bullion bar form and in bullion coin form, it's mostly held by investors, and it's almost at nearly record levels. And investors have been consistently adding to their inventories since around 2005, 2006. And that's why silver prices went from $5 in 2004 to $50 in 2011 and have stayed at historically high levels over the past 3 years. So why do we use our data? Because it makes sense and because it allows us to accurately project where the silver price is going. We don't listen to people who are marketing silver. Some of them listen to us, some of them don't. There are a couple other things I wanted to talk about in the silver market, clear up some stuff going around. Note this is the non-commercial gross long and short silver positions on the Comex, futures and options. The black line is the net, yellow is the long, blue is the short. And you can see this goes back to 1996 when the CFTC revised its COT basis. And you can see that by and large, investors like to be long on a net basis, and their gross longs have been much larger than their gross shorts up until around 2013, 2014. You can see those little blue things, A lot of people just don't like shorting markets. Institutional investors. Commercial entities will short the futures because they're hedging their long positions on the physical market, which is that stuff, some of it. In 2013, 2014, the prices of commodities across the board were coming down, and institutional investors started shorting silver futures much more dynamically than they'd ever before done in history. And you saw very large, historically large shorts, 2014, 2015, 2016. It pulled back a little bit, then 17, 18, 19. Enormous short positions held by institutional investors, most of which are funds that have pooled other smaller investors' money. And you can see that we actually went net short big time, bigger than ever before for a while during that time. That's very important to understand, because I'm going to get into something that is maybe a little esoteric to people, but you keep hearing now, oh my God, open interest has risen to the highest levels that it's been on the Comex silver futures contract. Open interest is higher than it's been for years. And this signals to the gold silver promoters that the price of silver is about to blow sky high. Okay, there are two things wrong with that. A, what is high open interest, large open interest? And B, what's the relationship between Comex open interest and Comex silver prices and silver prices in general? Okay, the green line here is open interest. And you can see back in the 70s when the Comex was used by a lot of producers, refiners, and fabricators, you had a much higher open interest level. They sort of moved away from that over the course of the 80s and 90s, and the Comex became much more of an investor market as opposed to a place where commercials were hedging their physical positions or laying off their positions. But here, just look at the recent decade, the last decade or so. Here's current open interest. And it has risen somewhat. But you can see it is higher than it has been for a couple years. But you can also see that it's lower than it's been for most of the period of time from 2013 through 2019. Now, 2013 through 2019, where have I heard about that period of time before? Oh, yes. In 2013 through 2019, open interest rose very sharply because institutional investors were shorting the silver market. So let's look at the blue line. What happened when interest rates rose, when open interest rose on the Comex silver market? Well, the price went from $40+ down to $12. Oh, that's interesting. Let's look at other periods of time. Let's go back to 1979, 1980, when the price shot way up. And what was going on with open interest? Oh, it fell by more than 70%. And I can look at other periods of time. When open interest rises, oftentimes the price falls. So the idea of high open interest on the Comex silver futures does not necessarily presage higher prices. You could argue that it might presage lower prices. You could also argue that it reflects the fact that there have been a lot of institutional investors who have been going short silver again because the silver market looks a little bit vulnerable to the downside. And understand and remember, these are short-term investors. These are not longer-term investors. And you can also say, hey, it probably doesn't actually matter. So that's where we are. There's a lot of stuff going on being said about silver that may not actually be true. In terms of Comex open interest, let's review. Comex silver open interest actually is not particularly high by recent levels or by historical standards. The most recent period of much higher Comex silver open interest actually coincided with the most recent period of lower silver prices. And as the price of silver subsequently began rising, open interest fell sharply because the shorts were liquidating their positions. The high open interest 2015 to 2018 reflected unprecedented volumes of short selling by institutional investors. And as the shorts unwound that high open interest, the price began to rise. So we do have a positive view for silver prices in the fourth quarter and in the next 3 years, but it's not predicated on the fact that open interest has risen to the highest level in 2 years. I hate to pop bubbles, but that's what people pay me to do. Let's talk about investing in silver intelligently based on real market information, real market data, real market analysis. That's what CPM Group does. You can read all about us at our website. You can buy our silver report, read it over the weekend, and Monday morning you may be a smarter, more effective investor in silver than you are on a Friday morning. Have a good weekend. Take care of yourself and those around you. Try to find something good to do for the world. Because as the people in Maui say, somebody needs to do something. Take care.